Okay, let's dive in. Welcome, everyone, to this deep dive where we're looking at different ways to approach investing. Today, we've got some really interesting material. It's from a YouTube transcript that, well, it really gets into passive investing strategies.
Yeah, it's fascinating stuff. And our mission today really is to, cut through some of the jargon that's out there. We want to break down that fundamental choice investors face, active versus passive, and explore why these passive approaches, things like index funds and ETFs, are just seeing explosive growth lately. And importantly, figure out how they might actually make the investment journey simpler for you.
Absolutely. So maybe you're looking at the market, thinking about investing, and you've hit this fork in the road, really. It's the classic dilemma, isn't it? Do you go active or do you choose passive?
That's exactly the starting point. So active investing, all right, that's probably what most people think of first. It's all about, picking individual stocks, trying to find the winners, trying to actually beat the overall market. And that takes constant research, analysis, monitoring. It's a lot of work. Usually means you're giving your money to a fund manager, and it's their job to make all those buy and sell calls.
Right. And the material points out this comes with, well, baggage almost. Typically higher fees, often higher risk too, because you're betting on specific companies. And honestly, the performance isn't guaranteed. You're really banking on that manager's skill day in, day out.
Precisely. Now, passive investing. It's a totally different mindset, built on simplicity, stability. Instead of trying to pick stocks, you follow a market index, like the Nifty 50 or the Sensex here in India. The fund itself isn't actively picking anything. No frequent trading based on hunches. You're just aiming to mirror the index.
And the features look very different. Simplicity, definitely. Stability, because you own a piece of everything. And crucially, lower costs usually. Plus, much more transparency. You know exactly what's in the box, so to speak. You own the index.
But here's the kicker. And this is a really key insight from the source material. Despite all the expertise active managers supposedly bring, despite the research teams and the higher fees, the stats, particularly in markets like India, show that the vast majority of these active funds have actually failed to outperform their simple benchmark index over the long run.
Wow. That really stops you in your tracks, doesn't it? It kind of challenges that whole idea that you need an expert actively trading to get ahead. And like the material says, this finding is a huge reason why we're seeing this massive shift towards passive. I mean, if the experts often can't beat the market after their fees, why pay more for the attempt? You could just own the market average for a lot less cost.
Which brings us neatly to index funds. These are sort of the classic way to go passive.
Okay, so unpack that for us. What exactly is an index fund?
Fundamentally, it's a type of mutual fund. But its goal isn't to beat the market, unlike active funds. Its only job is to track or mirror a specific market index as closely as possible.
Right. And how it works is, well, pretty straightforward. The fund buys the same stocks that are in the index, and in the same proportions, too. The material had a good example. Like, if Reliance is, say, 10% of the Nifty 50 index by weight, then a Nifty 50 index fund aims to also have about 10% of its money in Reliance shares.
Exactly. It's engineered to replicate the index's performance, warts and all. And this design directly leads to those benefits we mentioned. Lower cost, you'll see a low expense ratio. Lower risk, because you're instantly diversified across maybe 50 or 100 or even more stocks. Stable growth, it tends to follow the market long term. A performance that, well, it just tracks the index.
And the material called it putting your investing on autopilot mode. And, after thinking about the complexities of active management, that sounds pretty good.
It really does cut down the complexity. And it's this blend simplicity plus those real benefits that explains why passive, especially index funds, is really catching on. Catching on with what the material calls smart investors.
Okay, let's dig into that growing appeal. Costs seem like a really big driver here.
Oh, absolutely huge. Those lower expense ratios, they mean less of your money gets eaten up by fees each year, which means more of your money stays invested, working for you, compounding over time. It makes a real difference.
And that lower cost, it links to lower risk too, doesn't it? High fees are a performance hurdle themselves. Plus, your money isn't just riding on one person's calls.
Exactly. Then there's transparency. With an index fund, it's simple. You know what you hold. It's the index. No hidden corners.
And saves time, right? You're not constantly needing to check up on it, research manager changes.
Right. Less monitoring needed. Once you've chosen your index, the fund just does its job, which leads to consistency. Over the long haul, markets tend to go up. Index funds capture that broad market movement. They help smooth out the inevitable bumps along the way.
The material talks about a shift in investor thinking. suggesting that savvy investors today aren't just chasing the absolute highest potential return anymore. They're looking hard at the risk involved and the cost of getting those returns. And index funds are showing you can get good, solid market returns, often with much less cost and volatility.
hmm And that stability point is key. Investing across the whole index gives you instant diversification. So if a few companies stumble, it doesn't sink your whole investment. Others help balance it out. It cushions the blows.
And you can see the shift playing out in the actual money flows. The source shared some incredible numbers. The amount of money going into index funds in India, it went from just thousands of crores, back in 2017,
Yeah.
to potentially lakhs of crores by 2025. That's explosive growth. Tells you something big is happening.
It really is. And it's driven by a few things coming together. People are more aware of passive now. These digital platforms make it super easy to invest. And let's be honest, the track record. The data showing many active funds consistently underperforming their benchmarks. Investors see that.
But there's another benefit the material really highlighted, maybe a softer one, but powerful. The emotional freedom.
Oh, this is crucial. So crucial for long-term success. Our own emotions, greed when things are flying high, fear when they're crashing, they're often our worst enemies, investors. They push us to make bad, impulsive choices. Buying high because of FOMO, fear of missing out, selling low in a panic.
And index funds, just by how they work, they help you sidestep that emotional trap. You invest, you hold, you track the market. It's much more detached. The material called it making investing emotion-free, or at least less emotional, which is hard to do when you're actively picking stocks.
Exactly. You're not trying to time the market peaks and troughs. You're not worrying if your manager had a bad day. You're not tempted by every news headline to jump in or out. You set your course and stick to it. Takes a lot of pressure off.
So it makes total sense why index funds are seen as, trustworthy. The material points to that clear track record, no hidden fees, performance matching the index, good for regular investing like SIPs too, less bothered by short-term market noise.
And maybe the biggest thing, they encourage and reward discipline. That ability to stick with your plan long term.
Which circles back to that really powerful line from the source. Discipline is the key to wealth creation.
Simple but profound.
Nice.
Decades of investing success isn't usually about genius stock picks. It's much more about having a sensible strategy and sticking to it consistently through thick and thin. Index funds are built for that.
And the material notes, this passive wave started elsewhere, but it's definitely here in India now. Technology and easy access are big parts of it.
Yeah, the realization seems to be dawning on more people that just participating in the market's long-term growth, simply and cheaply through passive funds, that can often be way more effective than constantly trying and often failing to beat it.
Okay, so index funds are the foundation. Solid, simple, passive. Now let's talk about the next step, maybe the evolution. Exchange-traded funds, ETFs.
Right. The material presents ETFs as kind of the next level. Still passive at the core, but with added flexibility, liquidity, a bit more dynamic.
So define an ETF for us. How's it different?
Well, like an index fund, an ETF is designed to track something, an index, a commodity like gold, a specific sector, whatever. Its goal is still to mirror the performance of that underlying asset or index.
And this is the biggie, right? ETFs trade differently. They trade on a stock exchange all day long, just like shares of, say, TCS or Infosys. The material used the Nifty 50 ETF example. It holds Nifty stocks. But you buy and sell units of it through your DMAT account anytime the market's open.
That real-time trading is the absolute key difference. It means the ETF's price moves up and down throughout the day based on buying and selling pressure. Unlike a traditional mutual fund, where the price, the NAV, is only calculated once at the end of the day.
Okay, so the material compared index funds and ETFs on a few points based on this.
Yeah, so trading. ETFs are real-time price changes. Index funds are end-of-day NAV.
Buying, selling. ETFs use a stock exchange, need a DMAT account. Index funds are usually through the fund house or platforms.
Cost. ETFs often have even lower expense ratios, which is amazing, though you might pay a small brokerage fee when you trade them.
Liquidity. Generally higher for ETFs. Easier to buy or sell quickly on the exchange.
Control. With ETFs, you have more control over the exact price you buy or sell at because you're trading live. And the price itself. ETFs have that live, fluctuating market price. Index funds have the single daily NAV.
So basically, ETFs combine the good stuff from index funds, the diversification, low cost, transparency, but they add the trading flexibility you get with stocks.
It's a really neat blend, actually. You get some of that active trading feel, but within a passive, diversified structure. And that really helps explain why they're becoming so popular.
So what are the main draws? Why are investors moving towards ETFs?
Well, number one is that real-time trading, being able to react during the market day if you need to.
And potentially even lower costs. Those tiny expense ratios are very attractive.
Liquidity is a big one too, knowing you can likely sell and get cash relatively quickly.
Plus, you still get that core benefit, diversification. Risk spread widely across whatever the ETF tracks.
And the material mentioned potential tax efficiency too, especially if you hold them long-term. Might be advantages there.
So it seems the unique selling point, as the material puts it, is getting the best of both worlds. The passive benefits cost, diversification, plus the active-like flexibility in trading.
Exactly. And this combination makes ETFs incredibly useful tools for building a smart portfolio, specifically for asset allocation.
Asset allocation. That vital idea of not having all your money in one type of investment, balancing between stocks, bonds, gold, maybe international markets.
Precisely.
Yeah.
Diversifying across asset classes. And ETFs make doing this so much easier and cheaper than it used to be. The material gives some great examples of how you can use different ETFs for
Right, like using equity ETFs for your stock market exposure tracking, the Nifty, Sensex, maybe mid caps or small cap.
or debt ETFs like the Harap Bond ETF the material mentioned to get that fixed income part of your portfolio. Stable anchor.
And gold ETFs, brilliant. Invest in gold at market prices without physically holding it. No storage headaches, no purity concerns.
And international ETFs. This is huge now. Getting exposure to, say, the U.S. market via NASDAQ 100 or S&P 500 ETFs directly from India using your DMOT account.
It's quite powerful when you think about it. The material really drives home that you can build a properly diversified portfolio across all these areas, using just ETFs and a single DMOT account, and potentially avoiding layers of higher fees you might find in actively managed multi-asset funds.
It really puts control, transparency, and simplicity in the investor's hands, whether you invest lump sums or do SOPs. And because they're so accessible via trading apps, the material positions them as, the modern face of passive investing, likely to become even more dominant.
Okay, so wrapping up this deep dive, let's quickly look back at where we've journeyed. We started with that fundamental choice, active versus passive.
Then we saw how index funds really changed the game, offering that low-cost, low-risk, disciplined way to just capture market growth.
And today, we explored ETFs, how they take that passive idea and add layers of liquidity, flexibility, and real-time control through exchange trading.
And the big message threaded through all the material we looked at is this. Investing doesn't need to be super complex or feel like gambling. What it really needs is the right information, a sensible long-term view, and a disciplined strategy.
And the takeaway for you, our listener, seems pretty clear from the source material. Passive investing, whether through index funds or the more flexible ETFs, is presented as a really solid path. Suitable if you're starting out, suitable if you're experienced, but want efficiency. It's a route towards potentially good long-term returns, likely with lower costs and maybe less day-to-day stress, especially with today's easy-to-use platforms.
And we want to leave you with that final thought to chew on, straight from the source material. Discipline is the key to wealth creation.
Really makes you think, doesn't it? Could embracing that kind of disciplined, long-term approach, maybe using the simplicity of these passive tools, could that be the right path for your financial journey?